Sean Callow is Senior FX Strategist at Westpac Bank, live from down in Sydney. And joining us out of Hong Kong live is Dr. Marc Faber, editor, also publisher of the Gloom, Boom, and Doom Report. He's our guest host for the next 2 hours of this Monday edition of Squawk. So get your questions in for him. Email us at squawk@cnbcasia.com. Gentlemen, both of you, good morning. Great to have you with us. Dr. Faber, let me start with you first. It's a short week stateside. Just 4 days out from Memorial Day today. What are some of the things you're going to be keeping an eye out for?
Well, basically, since 2002, we had a very great correlation between asset markets and dollars. 2002 to 2007, weak dollar and strong asset markets. Then 2008, strong dollar and weak asset markets. And then since March, it's very interesting. On March 6th, the S&P bottoms out and then goes up 39%. But at the same time, the US dollar begins to weaken. And I think it's a sign that global liquidity is coming back into asset markets, and that we also had a shift from deflationary fears to more inflationary fears, and fears about the long-term value of the US dollar.
Okay, here's the thing, though. If we are shifting, Sean Callow, to inflationary fears, shouldn't we be worried about, the Fed at some stage having to play catch-up and to jack rates up, which would theoretically and usually does benefit dollar?
Yes, that's right. I'm not sure that that's the story for right now, though. Certainly the inflation risk is way out there, and anybody who's been undertaking quantitative easing obviously includes the UK with a massive supply of debt. And an increase in their most recent program of QE, that's definitely a concern for them down the track. But overall, the dollar's certainly under pressure, and clearly with yields are actually obviously at the 10-year yield has risen quite a bit, and I think we'll be watching the supply. There's a lot of supply this week, over 100 billion. Most of that's new debt, so we'll be watching that very carefully to see how the markets handle all that.
Sean, we've got a holiday in the US, also in the UK. Does that mean that we should be taking today's movements in the currency markets perhaps with a pinch of salt, given the fact that low volumes equals high volatility and some of the moves may be exaggerated?
That's for me? Yes, certainly you've got to be very careful of that. We had obviously an early close in the States on Friday as well, so we will be I think today's probably not the day to be drawing great conclusions on price action, but as Dr. Faber said, it was very interesting to see last week that you had broad US dollar weakness at the same time as you actually had equities and also bonds selling off, so that we're very interested to see whether that pattern sustains this week.
Sean, and despite the fact that we've got that holiday shortened week, we do have quite a packed data calendar out in the US, preliminary first quarter GDP, consumer confidence numbers, and also existing home sales and new home sales for April. How is the currency market going to digest those numbers?
I think there's probably limited interest in the GDP because we've already had the advance estimate, and we're expecting a mild upward revision, which still leaves it somewhere around -5% annualized, so hardly a great number. But consumer confidence will be worth watching, and home sales. The housing market has fallen so far that we're probably got to be at least close to a bottom there. But clearly in the market's sentiment over the past few weeks has been to buy risk assets when you see any of those fabled green shoots out there. So they will be watched closely, even though the housing market's got a very long way to go.
Dr. Faber, are you buying risk assets on this green shoots recovery story?
Well, I think now the situation has changed meaningfully. Last November and then again in March, sentiment on both the stock market and the economy were horrible. And so it was a good time to actually take a punt and go long equities around the world. And at the same time, in early March, sentiment for the US dollar was very bullish. And last December, sentiment for treasury bonds were very bullish. And right now, we had a huge shift. Sentiment for equities is very optimistic. People think that the low is in place and that we have all these green shoots. The only green shoots I can see are US dollar bills that are being printed by the Fed, as far as I'm concerned. The global economy is still contracting, but we have better bad news, that I have to say. but it's still bad news. And right now the mood is very, very bearish about the US dollar, extremely bearish about US government bonds, and as I said, bullish about equities. And so what we could have for the next 6 weeks is a slight rebound in the US dollar. Don't misunderstand me. It's not a positive call for the US dollar in the long run.
Okay.
And bonds rallying back a bit and stocks correcting.
Interesting.